Hey everybody, this is Matt Thomas at tradingparadigm.com, and today I want to discuss asymmetric risk reward. Asymmetric risk reward is simply when risk is not equal to reward. This can work in both directions, but as a trader, you typically want to capitalize on opportunities that present more potential reward in relation to risk. For example, a trade that offers a $300 potential profit for $100 of risk has an asymmetric risk-reward ratio of 1 to 3. The average risk-reward on trades can vary from trader to trader based on strategy, system, or methodology, but generally speaking, somewhere in the ballpark of 1 to 3 is the sweet spot. This isn't to say it's impossible to make money with symmetric risk-reward, like risking $100 in order to make $100, or even when it's skewed the other way, like risking $100 to make $90, but it requires a much higher win rate in order to be profitable this way. With 1 to 3 risk reward, for instance, you only need a win rate over 25% to be profitable. With a 1 to 1 risk reward, however, you need a win rate over 50% to be profitable. There are, of course, trading fees and commissions to consider for yourself as well, so keep that in mind for your own calculations and stats. But for simplicity's sake, we'll ignore those for now. A lot of inexperienced traders want and think they need strategies with high win rates, like in the 80 to 99% range. But this is often unrealistic, especially without cutting into the reward component of your risk-reward ratio. And having a win rate that high honestly isn't even necessary. Having a high win rate usually makes people feel good from a psychological perspective because you might feel better in the moment being right and winning more often, but having a high win rate doesn't always equate to overall profitability. In my experience, most profitable traders have an average win rate somewhere in the 40 to 60% range. Those who don't understand how the numbers work might think this is terrible, to only be right or win roughly 50% of the time, but you can actually make a lot of money with a 40% win rate and a 1 to 3 risk-reward ratio. If we plug these numbers into the expected value equation using a $100 average loss and $300 average gain, as well as the 40% win rate we just mentioned, you'll see that the expected return is $60 per trade. So if you're a day trader with these stats and you make roughly 5 trades per day, this could add up to some real money over the course of a year, even trading with this relatively small size. This doesn't even consider potentially scaling up to a point where you're risking $1,000 in order to make $3,000 per trade, which would have an expected value of $600 per trade. So with that being said, a ridiculously high win rate of 90% or more just isn't necessary in order to make money as long as you have risk reward skewed in your favor. This next point I want to cover is extremely important. A lot of people think that just because they have a stop loss and take profit order in place, that those two numbers automatically dictate their risk reward. But you can't just create risk reward out of thin air. It's the market that dictates the real risk-reward in any given situation, not you. To illustrate this concept, let's say that I power up my trading station and choose to buy a random stock at $5 per share. I then input a stop loss at $4 and a take profit at $105 because I want a 1 to 100 risk-reward. Sounds nice, doesn't it? Gigantic reward relative to risk. But is this risk to reward ratio real? Is this stock really offering a 1 to 100 risk reward opportunity? Or am I just being foolish? Is there anything from a technical or fundamental perspective telling me that my profit target is realistically achievable? Even though trading decisions are quite subjective, with millions of market participants using various indicators, strategies, systems, tools, and methodologies across numerous timeframes, the real risk-reward in any given situation should be based on context, whatever that means to you and your specific methodology. Examples of context can be how the market's reacting in relation to key price, volume, and time-based support and resistance levels. But what you personally use for context as far as your own trading strategy goes is ultimately up to you. So to wrap this concept up, randomly picking stops and profit targets doesn't mean the market is actually offering the risk-reward opportunity that you're choosing. The market tells you what it's offering based on context or market-generated information. And based on that, you decide if that opportunity aligns with your methodology and then place stops and targets accordingly. The last thing I want to cover in regard to risk management are the 5 potential trade outcomes. This concept is almost too simple, but it's extremely important to understand. The 5 potential trade outcomes are break even, small win, large win, small loss, large loss. If you can completely eliminate large losses and only allow yourself to experience the other 4 outcomes, then you can drastically increase your long-term profitability as well as drastically decrease the odds of blowing up. Big losses are detrimental on both a financial and psychological level and should be avoided. I'm sure there are many traders out there right now who are struggling, but if they looked at their stats and took out the big losses or replaced those big losses with small controlled losses, then they'd see that they can actually be profitable. It's not always the case, but sometimes it can be that simple. In the end, being a trader is akin to being a good risk manager. It's not about being right or winning on virtually every trade. It's about embracing uncertainty with a probabilistic mindset and capitalizing on situations that present favorable risk-reward opportunities. If you have any comments or questions, please share them down in the comments section, and you could find the link to this full article in the description. And I'll talk to you in the next video. Take care.